Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. This is another live stream. So as folks join, if you can hit the chat and just let me know if you can hear me okay. It's going to be a live Q&A. So those that join live can fire questions at me. We can talk about whatever. But the main topic today is actually going to be Portfolio Visualizer. It's a tool that I've used many, many times in past YouTube videos. I actually got a question from a viewer that said, hey, can you walk us through the tool a little bit so that, we can use it ourselves? Oh, that's a great idea. So that is what we're going to do today. As I said, for those joining live, drop your portfolios in the chat if you want. Say hello, all that sort of thing. Would love to hear from you. And yeah, that's it. So let's get started with Portfolio Visualizer, then I'll come back to the chat with questions. This is what it looks like. And there's a free version and there's a paid version. I'm showing you the free version at the moment. I have the paid version. I may show you a little bit of that too. It's not there, it adds some features. It's not dramatically different. Now, as you can see from the homepage, I mean, this thing does all kinds of stuff. Factor analysis, portfolio optimization, Monte Carlo simulation. And I can tell you I've used maybe 5% of what Portfolio Visualizer offers. What I want to focus on today are the features that I think you would use the most as sort of, like me, a retail investor. And it's over in this Backtest Portfolio box that you see. And the two primary tools are the Backtest Asset Allocation and the Backtest Portfolio tool. And the Backtest Asset Allocation, we'll look at it in a minute, but just conceptually, it allows you to look at how asset classes perform. So not specific mutual funds or specific ETFs, but just asset classes more generally, like, for example, large cap US stocks or gold or emerging market stocks. The Backtest Portfolio actually allows us to look at specific investments, whether we're talking stocks, ETFs, or mutual funds. And so that you could actually put your own portfolio into this tool, and it will show you how it's performed over some period of time. All right, so rather than, that's sort of conceptually the difference, let's actually go into each of them. So let's start with the asset allocation tool. A couple of things I want to point out right away. You'll notice that the starting year is 1972. That's as far back as this tool goes. Can't go back any farther. Although that's, almost 50 years. So that ain't bad. You could change that. You don't have to have the starting year as 1972. You can change it to whatever. And I've done that many times on the show. You might, for example, want to look at how an asset class handled the tech bubble. So you might start it at 2000. Yeah, for example, or you may want to see how it handled the 87 crash right here, right? So you can change the starting year. You can also, of course, change the ending year. And I'm just really focusing on those tools and those parts of the tools that I think will be most useful to you. You can obviously start with whatever initial amount you want. Cash flows. This is very handy. I've used it many times. You can either contribute a fixed amount if you're still accumulating and you're saving whatever, $500 a month in your 401k or whatever the amount is. You can set a contribution amount. And you can also, for those of you like me are in retirement or close to retirement or semi-retirement, still not quite sure what to call what I'm in, but you can withdraw an amount, whether it's a fixed amount or a fixed percentage. And with all of these, and I'll just pick contribute a fixed amount, we can put in, again, whatever we want. Let's just say $250 a month. And then you can, whether you want to adjust it for inflation, you can do that. And then the contribution frequency, you can say, okay, well, this is going to be monthly, quarterly, or annually. We'll say monthly. And then rebalancing, yes or no. You can rebalance annually, twice a year, quarterly, monthly. No rebalancing. You can also do rebalance bands, which I talked a bit about in the last video on rebalancing. I haven't actually used this feature at all, actually. So, but that's the concept. And we'll look at that in another video, but it allows you to set up bands where it allows you to allow your portfolio to asset class to deviate by some amount before it would trigger a rebalance. So we'll just say rebalance annually for now. You can compare it to a benchmark if you want to, your portfolio, and you can give it a name. And we'll come back to that actually. So we're really where we get into the asset classes we want to model. And you can pick from a pretty extensive list. You've got various US equity classes, including large cap, small cap, and mid cap, growth and value. And then you've got international equities. Then you've got fixed income, and pretty much about everything you'd want, I think, for the most part. And then you've got alternatives, REITs, gold, precious metals, which would be more of a basket of metals as opposed to just gold, and then commodities. The other thing you can do, and I find this extremely useful, is they have sort of pre-programmed portfolios. If you click over here and you click this link, you have different ways to allocate weights. But what I find even more interesting is they have what they call these list of lazy portfolios. And we've looked at some of these in the past. So here's the 3-fund portfolio as an example. If we were to click that, it automatically gives us the relevant asset class and the percentages. Of course, you could go in here and change this if you wanted to, but it gives you the allocations and the asset classes. And you can then compare up to 3 portfolios. So this is the 3-fund portfolio. We could go in and say, oh, David Swinston, we've covered his portfolio before, so we'll do that. It's a little more involved, I guess, more asset classes. And then my good friend Rick Ferry's in here, I think. Yeah, the Rick Ferry Core 4. So we'll just use those as examples. Of course, you could obviously customize your own. You don't have to use these, but it makes filling it in easier for this demonstration, and we'll analyze the portfolio. Now, one thing I want to show you that's really important, and it took me a little while to figure this out, even though it seems kind of obvious now. Remember, we put 1972 as the starting year, right? And by the way, big shout out to Dan. Good to see you're on the chat, and thank you for your spreadsheets. He's the guy behind the 529 spreadsheet and the investment spreadsheet. Anyway, you'll see that 1972 is the starting year. When you come down, though, and look at the results, you'll notice that it doesn't start in 1972. It doesn't start until January 2001. Why? Well, in these portfolios, it tells you right here, one of the asset classes happens to be TIPS, Treasury Inflation Protected Securities. Here it is. It's part of David Swinson's portfolio. And Portfolio Visualizer doesn't have data back to 1972 on TIPS. Why? Well, for starters, TIPS didn't exist in 1972. I don't know when they started. I'm not even sure it was January of 01. I thought it was earlier than that. But in any event, the point is, depending on what asset classes you're trying to model, there may be limitations on how much data they have. That's also going to be true, as you'll see, when we look at individual investments, individual ETFs or mutual funds. So you want to keep that in mind. And then we look to the results. The first thing they do is they show you a nice sort of summary of each portfolio, both sort of in a table view and then in this nice graph view, which I think is extremely helpful. And then they do that for each of the 3. One of the things I'd recommend, and I probably don't do it enough in my videos, you'll notice when I analyze it, they give them names, portfolio 1, 2, and 3. Well, that's not very helpful, particularly, by the way, when you come to the results and you're like, wait a minute, which one was portfolio 1? I forget. So what we can do is we can come up here and we can actually use custom names. Now, if you use one of their pre-populated or pre-programmed lazy portfolios, it fills in the name for you automatically. So that's nice. If you're creating your own, you'll just type in the name. And in fact, I could change this if I wanted to. But I'll do that. I have to rerun the analysis for the names to be entered. And now you can see we've got the names here. And that's just a lot easier. And when we come down and we look at the performance, we've got the names as well. And shout out to Zod. Thanks for joining, man. And we can see the results. So it looks, oh, look at that, my good friend Rick. So I met Rick, I've known Rick for years. I will give a big plug for one of his books. It's called All About Asset Allocation. Let me just, I assume it's still for sale. It's an older book. Let me look. All About Asset. This was like my first real introduction into asset allocation. I read that and was like, aha, I get it. Here we go. Here it is. I don't know when it was first published. This is a second edition. I'll leave a link to it below, but obviously you can just Google All About Asset Allocation. Rick Ferry wrote this. It's a great book. It's a great book on asset allocation. In any event, we can look at the results of this analysis. We've got this is compound annual growth rate, and they give you some information. There's also an inflation adjusted rate if you want to look at it. To be honest with you, some of these I don't even focus on. Like, we've talked about Sharpe and Sortino ratios in the past. They can be relevant. The truth is, what I'm looking for primarily from this chart, when I'm looking at portfolios, is the compound annual growth rate. I want standard deviation, which is a measure of volatility. And for all of these, the difference between 12.2 and 11% is pretty significant. I mean, it's not earth-shattering. But you'll see it in the numbers here when we see worst year and max drawdown. The worst year, there's a difference between 30.3 and 26.8, 26.78. And the worst years are different. Again, not earth shattering, but that's kind of what I am looking for the most part. And then they give you some graphs. This is a portfolio growth. They show you the annual returns. This, again, by the way, it comes in handy when you've named the portfolios. Then they give you some annualized returns. One thing they can do, let me see if they still do it. It may be in the other tool. It's in the other tool. I want to show you. They'll show you in the other tool. We'll look at it in a minute. The income, that is dividends and interest. I know a lot of you are big fans of dividends. I'm a big fan of dividends too. I just don't go out of my way to try to get them. I let the market give me whatever dividends it wants to give me. But we'll see in the other tool we can look at that. So that's the basic idea of this tool. And again, you can customize it with your own asset classes. Sometimes, we can clear one of these, right? We'll just clear this one. Whoops, that's not what I wanted to do. We'll clear it. Sometimes I'll look at a portfolio and I'll say, you know what? Everyone loves gold. How would gold have compared? What if we just had gold 100%? How would that have done? And actually, before I look at the results, probably should rename Rick's portfolio to gold. All right. How would that have done? It actually would have held up pretty well. I'm actually surprised at that. That's not bad. That is not bad. And in fact, at one point, it was way ahead. How about that? That actually surprises me. Well, there you go. For you gold bugs out there, I mean, that's not a bad deal. And its standard deviation is certainly high as compared to Swenson's portfolio. So yeah, a roller coaster ride. So that's the deal there. By the way, keep throwing questions and comments into the chat. I'm going to turn to them as soon as I get this done. All right, so that's the first tool. The second one I want to show you is where we can actually look at specific funds, ETFs, mutual funds, or stocks. Now, the one thing is, you notice the oldest year they have, the earliest year is 1985. They don't go back further than that, although that's still, 35 years. And most of the things are the same. Notice, though, we've got reinvesting dividends, yes or no. That's new. And we've got display the income. I'm going to actually mark this as yes for the moment. And basically the same idea, except rather than a drop-down list of asset classes, we can actually type in tickers, VTI, for example, Vanguard Total Stock Market. I'm going to actually get rid of that, because just like before, we can put in specific portfolios, and we'll go with some of the same ones we went with in the past, in the previous screen. Here, what they do, they give us the allocations. Again, you can change those, but rather than giving us an asset class, it gives us an actual investment. So for the 3-fund portfolio, it's Vanguard Total Stock Market, Vanguard Total International Stock Market, and Total Bond. And we can come down here. We'll look at David Swenson's portfolio, and we'll go, just to keep it similar for the moment, we'll look at Rick Ferry's, and we'll name them. So we've got the names there, and we're showing income, and we can analyze the portfolio. We get the same table and graphs, so that's good. And now, again, we always have to remember the year. So remember, we started, in theory, it goes back to 1985, right? But as with the previous screen, this one too is limited because of the data. So again, TIPS, it's the same limitation. VIPSX is Vanguard's inflation protected fund, and it's limited January 2001. And that actually, and I realize you can't see the screen. Here we go. That's a little better. Sorry about that. And I even have, by the way, I even have this thing here that tells me what you can see, and I still fouled that up. You really ought to give this video a thumbs down. No, please don't do that. All right, whatever. Here we go. You can see the screen. I got to start all over. On the portfolio asset allocation, we can go from 1985. We've set the income to display. We're going to reinvest our dividends. I've put in the same 3 lazy portfolios we did on the previous screen. I've analyzed it, and you'll notice we're limited to 2001, and that's because of the TIPS, same issue, and we can see the results, right? And when we come down to the balances, of course, they're much smaller than if we were to, if we could have analyzed this out to 1985. But we get to see the results, and they're all in line with one another. They're not dramatically different, but we've got the same data. We've got the compound annual growth rate, we've got the standard deviation, the best and worst years, and the max drawdowns. And if we scroll down, in addition to the annual returns, we see income. So this is the portfolio income. This would be dividends from stocks and interest from bonds. And we can hover over any one of them, and we can see what they've generated. One of the things I want to point out, and this actually is going to go to a question I want to address in just a minute, that someone emailed me today. This is the total income, right? Dividends and interest. And you'll notice what happened, and things seem to be okay. They kind of go down, right? Because remember, we had a bad market, obviously, 01, 02, the tech bubble. So if you're living off dividends and interest, you're living on a little less each year, depending on which portfolio you have. Of course, we're only looking at $10,000. In fact, let's just change that just to make it a little more realistic. We'll add a couple of zeros. By realistic, I mean, if you're retired, it's still the same thing. You're living on a little less each year. And then they start to go up in 04, 5, 6 is kind of a wash, but it goes up in 7, kind of stays the same in 8. And then, of course, it goes down significantly in the last recession. And even if we fast forward to 2020, it went down because, when we had the pandemic, the market as a whole did well, but a lot of companies had to cut or even eliminate their dividends. And so it's something to just keep in mind. You can actually have dividend yields go up in a bear market, and yet the actual amount of the dividends you get could go down. Just something to keep in mind. So that's the second tool. I will mention one other thing that could be useful for you guys and gals that are in or near retirement. For the cash flows, we can withdraw a fixed amount, right? So we could say, all right, I want to withdraw, we'll say 45,000 on $1 million portfolio. So that's 4.5%. It's going to be annually. We're going to adjust it, the amount for inflation. And how would that look? Well, we can come here and we can see. And one of the things it shows us is the final balance, meaning as of today. So if we had retired in January of 2001, given all the assumptions, we've got 3 different portfolios. Each started with $1 million. Pretty significant difference, by the way. It's interesting that David Swenson's lazy portfolio ends up with 1.8 million, significantly more. And so one of the things you have to keep in mind is when I see that, my first reaction is not, oh, well, then David Swenson's portfolio is obviously better than the other two. It's the first question I think you should ask when you see this sort of data is why? Can we figure out why David Swenson's portfolio did better? And we'd look at what it's invested in. This is real estate. It's got developed markets, but so does the other one. They have international. It does have short-term treasuries and tips and emerging markets. That doesn't really immediately jump out at me as to why it's outperformed. And that's something that we'd have to figure out. It looks like a lot of it might come with how it did out of following the Great Recession. So that would be to me, I guess my point I'm trying to make is this data really represents the start of the work that you have to do, not the end, right? So that's just something to keep in mind. When I see this, I don't just conclude that whichever one is hired is the better portfolio. Although, that's pretty significant and that raises some interesting questions. So that is how I use Portfolio Visualizer 99% of the time. I will show you, let me log in because there is a paid version. I do pay for it. And it has some other interesting features. One of the things you can do, and I'll just show you, if you come here and you're going to see all of these portfolios, well, you can save your own, right? So here are the lazy portfolios that we've seen before. But here are some that I've saved in the past just from past videos I've done. So if you have the paid version, you can save a portfolio of your own. The other thing you can do is, how some asset classes Portfolio Visualizer has limited data. So we looked at let's go to asset allocation. We looked at tips. And it was limited to 2001, right? Let's just use this as an example. Yeah, it's limited to 2001. One of the things you can do with the paid version is say, hey, Portfolio Visualizer, if you're limited for tips, I want you to then, for the periods before 2001, use this asset class or this investment instead. So if you could find something that you thought was comparable to tips, you could tell Portfolio Visualizer to use that so that your data could go back further in time. Those are the two things that I probably use the paid version for the most. But there are other features that I haven't even gotten into yet because this thing's got so many features that the paid version also gives you. I think for the vast majority of people, unless you want to start a YouTube channel, the vast majority of people, the free version is all you need. So that's the tool. I'm going to turn to the chat and see what you guys are up to and what you want to talk about. So let's see here. Sir Friendzone has a portfolio he's put in, and I don't know some of this. Let's look at it. I don't know some of these investments. Although I see he's got an ARK fund, and I'm just not a fan. You guys know that. Did you see the Twitter back and forth between Kathy Wood and Burry, who remember called the housing problem and made a ton of money? He's now shorted ARK Innovations. And then there was another guy that got into it with her. Anyway, I don't really see the point of ganging up on Kathy Wood. She believes in what she believes in, and I got to give her a lot of credit for holding her ground. I just worry that a lot of people are going to get hurt. But so RYLD, I don't know what is that? Oh, Global X Russell 2000. Oh, covered call. I am not a fan of covered call ETFs. I'll tell you that right now. And probably some of you are like, Rob, what the heck is a covered call ETF? BIOV, small cap value. There's nothing wrong with that. AMC, really? You own AMC? I don't see the whole portfolio. I think, let me just see if I can get into the whole thing. No. I don't see your percentages for ARC. Well, we can talk about them generally. You've also got ARC. This is not innovation. Oh, it is fintech. Oh, fintech innovation, right? So, and I've got the percentage. I don't have the percentages, so we'll just talk about the individual investments. So you've got 50. Yeah. See. Unfortunately, the chat, the way it's set up, and maybe I just need to. Let me see if I can do this in a different way. Here we go. Maybe. No, it cut off. In any event, looks like you got 35% in a covered call. I'm not a fan of covered calls. I don't know if you guys want me to get into covered calls today. Basically, a covered call, if you sell a covered call, what you're doing, let's say you've got 100 shares of Apple, and you sell an option to somebody, the buyer, and you say, I'm going to sell you my 100 shares, and you have an option if you want to buy them or not. You don't have to, but if you want to buy them, you can. I'll let you look at me for a second. If you want to buy them, you can. And I'm going to leave this option open for a certain period of time. Could be years, could be days, could be weeks, months. And we're going to agree on the price now. They call that the strike price. And so let's say that Apple's trading at 150. The strike price could actually be less than 150, right? Let's say it's 140. That seems odd. It's like, wait a minute, why would I agree to sell my Apple shares that I could get 150 for? Why in the world would I agree to sell them for 140? Well, you pay me enough. You're going to pay me the $10 to get me up to the current price plus a premium for the call option, right? So, you pay me $12 a share or whatever. Yeah, I might be willing to. Many of the covered call ETFs are what they call at the money. So the strike price is, if they're trading at 150, the strike price is 150. If you're just selling covered calls to try to generate income, you're usually probably selling out of the money calls. So, a strike price of like 160. The problem is with options generally, if you're buying them to try to make a few extra bucks, is that whether or not it turns out to be a good trade depends entirely on the short-term market fluctuations, right? And I just don't think anyone can predict them. And so the covered call ETFs that I've looked at generally are just not great investments. So that's my take on it. That's my very quick take on covered calls. VU, great fund. I don't know this one, but obviously it's a Vanguard small cap value fund. Nothing wrong with that. AMC, its fundamentals don't support the price. I understand, the meme stocks and maybe short squeezes and all that sort of thing. And so maybe you're in it like this is a short-term play. To me, that's not investing. Doesn't mean you can't make money on it. You're more of a trader kind of thing. It's just not my thing. And ARC Fintech Innovation, the problem with that one is just, again, the fundamentals. I mean, most of the companies in their funds don't even make any money. And their valuations, whether it's PE, price to book, price to sales, are just off the charts. So I'm not a fan of that. So that's my take. All right. I'll share my screen again. Let's see what we got. Greetings from South Carolina. Hi, Rob. Your videos have been fantastic. Thank you. Is there an asset class you might use to simulate stable value funds? I mean, I guess my first question is what you really mean by stable value funds. You can certainly invest in stocks that aren't as volatile as, for example, what Kathy would invest in. Older companies pay a dividend, their volatility isn't as significant. I generally like to deal with volatility in a different way. And that is with the right asset allocation, living well below my means, having no debt. That's generally how I like to do it. All right, got another. Sean's got a portfolio. Let's take a quick look at that. And I am sharing my screen, so I got that going for me. So he's, this is simple, VTBLX. What is that? VTBLX. Well, we're going to find out. That's, he's got that 30% in that. And then he's got VTSAX. We know that one is 70. And that's it. Is that just the bond? Is it VT? That must be the bond. But I don't know I know the ticker for the ETF. I don't know if that's the same thing, but It's a clearly a bond fund. And that's a great portfolio. I love that. I mean, low cost, it's 30/70. I don't know the specifics of your situation. Obviously, this is not investment advice. This is just my opinion on that portfolio. Nice and simple. It's if I were accumulating, like if I were 30, 40, 20, I would have more than 70% in stocks. That's just me. I'd probably have 90. Um, but otherwise, that's a great portfolio. Just saying, wondering, what would you invest in instead of bonds due to the low interest rates? Well, I wouldn't. I'm generally not one to try to invest in what people would say is a bond alternative, right? So some would say, well, invest in utility stocks. Well, I mean, if you want to change your asset allocation and allocate more to stocks, that's a decision to be made. If I'm going to do it, though, I'm probably just going to invest in the market. Utilities can be extremely volatile. I mean, I understand not like some other stocks, but you're really changing the risk profile of your portfolio. I mean, it's not that it's necessarily a bad decision. I just think you need to recognize that what you're doing, it's just not, it's totally different than bonds, I guess is the point. So I really wouldn't call it a bond alternative. You can go for more yield with like high yield fund or emerging market debt. But again, you're taking on pretty significant risk. And, this is where I just think most investors should just be patient. I understand yields are low. There's good and bad in that fact. Um, and I kind of just look at it as patience. And um, so, I have gone a little shorter on the duration of my bond portfolio. It used to be all intermediate um, bonds. Now it's probably half short term, half intermediate. But I really haven't tried to, go to utility stocks, preferreds. I see, John, you mentioned preferred stocks. I've never invested in preferred stocks, at least not directly. I own Berkshire Hathaway, and Berkshire Hathaway is on preferred stock, so I guess indirectly I do. Again, I wouldn't see those as bond alternatives. They're just different. Um, okay. Um, I agree, Laura. Swinson had the best returns and the lowest standard deviation, which is that's worth looking at in a little more detail for sure. Let's see what else we got. Andy, he says, what do you recommend for someone at age 24 with Roth maxed out to do next? Well, are you contributing to a 401k? That's the first question, or other workplace retirement account. I'm assuming the Roth is the Roth IRA, but that's an assumption. You could be referring to a Roth 401k. If that's the case, then I'd go to a Roth IRA. If you're maxing out an IRA and you're either maxing out a 401k or other workplace retirement plan, or you don't have one, then I think for the most part it's taxable, which is what we did. I mean, we were maxing out 401ks and IRAs, and then you just go to taxable. And I kind of like the diversity. I wish we had more in Roth accounts than we do. But I kind of like the diversity. So, I mean, if you're maxing out an IRA, and let's assume you're maxing out a retirement workplace fund, I mean, that's a good problem to have. Multiform asks whether Portfolio Visualizer has UK funds, and I don't believe that it does. Every time I've tried to search on a foreign mutual fund, like one offered in the UK, for example, it doesn't come up. So unfortunately, no. Sean asks, I don't want to link my accounts with personal capital. Any way to bypass it and still be able to use the tool? Absolutely. And I'll show you. It's a great question. And in fact, and I'll pull it up on my screen here in a minute. I know you're still looking at me. Let me sign in first. And this is a demo account that I created, meaning it doesn't have my personal investments. You've seen this before if you've watched past shows. Let me pull it up and I'll turn on my screen to show you. All right. So here it is. I've just created, with the exception of this first account, which is my credit card rewards that I invest in M1 Finance. That actually is my account, and it is linked to this particular personal capital account. Here are my holdings. All the others are manual, right? And so the way you do it is you hit this little plus button, and instead of clicking on, let's say you have an account at whatever, Vanguard, right? You'd click this if you wanted to link your account. But what you can do instead is click Add a Portfolio, give it a name, and then you click Done, and you get this screen. And you can just start adding your investments, right? So we could put in whatever, VTI. And if you hit the tab button, it brings in the price. I'm assuming that's accurate. The name of the fund, in this case, the Vanguard Total Stock Market, and you can put in your share number, whatever. And if you want to track your cost basis, you can put that in, and you click Done, and you can enter as many investments as you want. So yeah, you don't have to link your accounts. Great question. All right. Yeah. Simon, I'm maybe mispronouncing that. All he's got is GLD. He loves gold. Jay asks a great question. He says, Rob, love your videos. I just discovered your channel. Do you have an M1 pie that shows your current investments about the same age as you? I don't, but I'm going to create it, and I will create it, and I'll do a video on my investments. I kind of held off on it because and I'm going to stress this when I do the video. I don't want people to see my portfolio as anything special, because it ain't. I can tell you 80% of it is low-cost index funds, mainly Vanguard, and then 20% is individual stocks. And the only reason it's that much is because my individual stocks have done reasonably well, most notably Apple. I started investing in Apple in 2013, bought more in 18 and then 19, and it's just done extremely well. And so it's grown to a point where it's probably a greater portion of my portfolio than it should be. Once again, a good problem to have, right? All right, but I will do that, Jay. That's a great question. I'm going to do that. All right. Hamid asks, what do you think of hedge fundies portfolio made up of UPRO, TMF, UPRO/TMF 5545? Well, I don't know, and I don't even know what that is. Are those tickers? No clue. UPRO, is that a ticker? Pro shares. The Ultra Pro S&P. Is that leveraged? It's got to be leveraged, right? Let's look at this portfolio. I have no idea. That's what I like about the YouTube channel. I learned so much from you folks. Well, it's crushed it compared to the 70-30 portfolio. Look at that. That's unbelievable. This has got to be a leveraged portfolio or a leveraged fund. I mean, ProShares does a lot of leveraged stuff. Let's just see. Is it leveraged? Yeah. Yeah, so this is a 3x. I don't know if they probably don't use leverage. They probably use futures or options or something, but you guys can't see that, can you? Let me make it a little bigger. Yeah, it's a leverage. It corresponds to 3 times the S&P, which explains why it's done so well against any portfolio, right? Any unleveraged portfolio. The problem is, so the problem would be, for example, let's change the time period for a moment. Doesn't go back that far. The problem is, in a bad market, you're going to take a beating. And I just am not a fan of trying to leverage or, use funds that try to return 2 or 3x or whatever of an index. But, I can't, you can't fault you can't deny that if you pick the right years, the results are crazy. This fund, I don't know. I mean, I can read it and see. Okay. Well, gang, you're not going to believe this. I got to run. And the reason is I ordered a car today and they're delivering it. It's nothing fancy. It's a minivan. Well, what can I say? We're grandparents. That's what we do. I'm going to be doing more of these live streams. I'm thrilled that so many people joined. And I may even do one later this week. Next week, probably not, but the week after that, I plan to do them every single week. So thank you for spending a few minutes of your day with me. You guys are Amazing. The questions are great. I'm learning more and more. I never did get to the question I wanted to actually address. That's okay. We'll get it next time. But got to run. Remember, the best thing money can buy, apart from a minivan, is financial freedom.